Welcome to this Bell Direct monthly update. I'm Julia Lee, an equity strategist with Bell Direct. And with it being the close of the first month of 2017, it's time to look at the winners and losers for January. In January, what we have seen is commodity prices continuing to rally, and that means the upgrade cycle, which started in the second half of last year, has continued for the big miners on the market. So if we have a look at the best performing sectors, in the lead is the material sector with a gain of 6.3%. The healthcare sector has also bounced back with a gain of 5.8%, and that's mainly on the back of CSL's upgrade to full-year earnings guidance. And the energy sector also doing well with a gain of 2.4% on the back of some of those OPEC production cuts starting to take hold. In fact, it's been a pretty good market since the US election on the 8th of November. In particular, we've seen the energy sector and the material sector gaining around about 13% since the US election. On the flip side, the worst performing sector has been the property space. We've seen every single stock in this sector decreasing in value except for one. And this, I guess, coming as investors reset their expectations on bond yields and expectations around rising bond yields around the globe. Unfortunately, bad news for some of these high-yielding stocks, especially in terms of the property space, the telecom space, and the utility space. We've also seen the consumer discretionary sector coming under pressure, down by 3.5%. And the losses here have really been led by the retailers like Myer, Premier Investments, as well as Ardent Leisure, still coming under pressure after the Dreamworld incident. But altogether, concerned around a softer Christmas Boxing Day trading period is driving some of the losses in this space. And of course, this month we also saw updates from Oroton as well as Shaver Shop, which were quite soft, adding to the concern around the discretionary retailing space. And finally, industrials also coming under pressure with a loss of 3.1% for the month, driven by Brambles and the profit downgrade that we've seen coming through from Brambles on the back of softness in its North American business. Looking at the top and the bottom performers for the ASX 200 index, and really the moves here have been driven by confession season. And this is where companies that do expect to see a deviance of more than 5% in terms of their earnings from guidance come out to let the market know. On the good side is Bega Cheese. Now, Bega is one of these companies that has been trading on relatively high multiples but doesn't have a high return on equity ratio. It has a return on equity ratio of about 9%. But recently it did announce an acquisition of brands like Vegemite as well as some of the craft products, and the stock up 26% in the month to date. This acquisition was done at a good price and will be earnings per share accretive and should help to support a better growth profile for Bega Cheese. Galaxy also doing well, the lithium producer, now producing lithium at its Mount Cattlin mine, the stock up 21%. Not only that, but Galaxy has managed to sell about 120,000 tonnes through an offtake agreement out of production of 150,000 tonnes, which is expected for the full year. And that price locked in at around about $905 US a tonne. So that stock doing well. And BlueScope Steel out with a profit upgrade this month, up by 21% in terms of stock price action. So the top movers really being driven by an improving earnings profile. On the flip side, the bottom movers being driven by a decreasing earnings profile. Bellamy is down 43% for the month to date. We have seen its troubles continuing. Western Areas down 21% as Indonesia eases the nickel export ban and nickel miners come under pressure, and Brambles down by 15% on the back of a profit downgrade to guidance. But I guess being the start of 2017, it is worthwhile looking at what's expected for the year. And this chart is courtesy of RBC and looks at longer term market secular cycles. At the moment, it does look like we are at the start of a secular bull market. And that means any downturns in 2017 should be seen as an opportunity to buy. Having a look at the next chart, and this looks at the Australian share market over the past 1 year. you can see that recently the market has seen a slight pullback around about 3% from the highs that we saw in January. But still, we have bounced off 5,600 points, and as long as we remain above 5,600 points, it looks like the market still very much in an uptrending mode, with record performances seen by the US indices, the S&P 500, as well as the Nasdaq towards the close of January. In terms of tactical portfolio allocation, well, what does this mean for your portfolio? Having a look at how the Australian share market has performed when the market has been rising versus how which sectors have been performing well when the market has been falling through the last 10 years. And usually in a rising market, you see the growth areas of the market and the cyclical areas of the market outperforming. These are sectors like the material sector, the energy sector, the consumer discretionary sector, and the industrial sectors. On the flip side, if you think that the market is going to fall in 2017, then usually it's the defensive areas of the market which do outperform. And this includes sectors like the healthcare, the telecom, the utilities, and the property sectors. Of course, there have been exceptions to the rule, most notably between 2011 to 2015, where the main driver of the market was falling interest rates and negative real interest rates around the globe. And this meant it was very much high-yielding stocks which were the beneficiary in that time period. But generally, outside of, big rate movements and financial disruptions and abnormal conditions, usually in a rising market, you do see the cyclical areas doing well. So being at the start of a cyclical bull market or a secular bull market, we do expect those cyclical stocks to be doing well and would be overweight in areas like materials, energy, industrials, and consumer discretionary this year, while being underweight in some of those defensive sectors like healthcare, utilities, telecom, as well as the property sectors. Looking at what's ahead, and the big event for the Australian share market will be the half-year earnings season, which kicks off in February. Now, the first couple of weeks, it is a little bit slow, but in the first week of February, we will see half-year numbers coming through from GUD Holdings, Tabcorp, as well as quarterly numbers from James Hardie. And coming closer to that earnings season, keep a watch out on the Bell Direct website if you do want that calendar of events for February and that half-year earnings season. So that's it from me. Overall, it's been a pretty good start to the year for the Aussie share market. In particular, what we are seeing is very much growth-orientated strategies outperforming, and we have seen the materials and the energy sectors outperforming, and we think that this is going to be a theme throughout 2017. Thanks for watching the video. I'm Julia Lee, an equity strategist from Bell Direct, and hope to see you next month.